Okay, hi guys. Good morning or good afternoon, depending on where you are. Welcome to the FX Street webinar. I'm Ian Coleman. I'm one of the traders and analysts at First of Trading. We produce technical analysis and trade calls on 13 FX pairs, stock indices, gold and oil. Basically been hosting webinars for FX Street, I think for about 4 years now. And what we like to do at the start of every month is what we call a time frame breakdown, okay, or the medium term analytical outlooks for the currency pairs. And that's what we're going to do today. So the main focus and the thing that I look at every day, and one of the first things that we send out in our morning reports is the dollar index. Okay, obviously out of the 8 FX major pairs, the dollar index is involved in 6. Okay, so if we can get a good bias on the dollar index, we're not necessarily going to trade the dollar index, but if we can get a good bias on the dollar index, then we can have a tendency to get our trade calls for the day, or at least 6 of them relatively well analysed, should we say, okay. But what we also want to do is we want to look at the big picture, okay, because we want to know whether or not we're trending, counter-trending, whether or not we're in some consolidation, quite importantly, whether or not we're in a Ishimoku cloud on a daily or weekly chart, because this has a tendency to produce very choppy intraday trading. And then we want to break it down. So we break it down through time frames to get our intraday calls, okay. We produce medium-term calls on a Monday, which have a longer focus, okay, maybe 10 to 14 days to stop or targets. And then every day, Tuesday to Friday, we produce the intraday calls. The reason we don't produce intraday calls on a Monday is because basically we like to have the market digest all the weekend news, and we can get very choppy trading at the open, okay, which is 7 o'clock UK time for us. So what I'm going to do, I'm not going to rattle through all the majors today, but what we are going to do is, if it's okay with you guys, I thought that I'd talk about the medium-term calls, where I'm seeing prime support, resistance, what I'm expecting to happen over the next sort of 2 to 3 weeks. But then, just using the Saxo Trader 2 platform, I'm just going to go on and talk about building a basic trend following system, okay. It's very well, it's all turning around and saying, oh, well, you want a dollar, it's well bid today, it's going to go to the upside. Okay, if we don't know how to trade that, and we don't know what our risk tolerance is, etc., money management, then we can still blow out having the right view on a currency pair. And hopefully this will all be explained when we get onto that. So hopefully we can get through to all the FX majors within the sort of first 30 minutes. If you do have any questions, please feel free to post them into the chat. Sometimes it helps me as well, because I want to make sure that I'm explaining everything to you guys correctly. And then we're going to talk about, obviously, a basic system and deciphering what is a trend, okay. And that will then formulate into what I'm talking about now, the medium-term outlook, okay? Because, as I said, it's okay having a medium-term outlook, but you need the intraday or the short-term outlook to line up to really get that clear trade, if you like, or that clear view. So this is the dollar index. This is actually a monthly chart, or weekly chart, I should say, sorry. And this is what we deem to be an ABCD correction. So we've got impulsive leg, corrective leg, and then down in CD. And then we look for this leg here, and this was obviously impulsive to the upside. So our view on the dollar is now bullish in the medium term. But you'll notice as we break down through time frames, okay, so we go from the weekly down to the daily. We'll make this quite big. So I've got 3 screens on. I'm able to work off the smaller screen here, just so that we can see properly. Okay, so this was our impulsive move to the upside. Okay, so a doji day, an impulsive move, and this is what I'm talking about, the cloud. Okay, if you look at euro dollar as well, anybody who looks to Ishimoku cloud, okay, Ishimoku cloud in its most basic format is something that shows us support and resistance. The reason that I like it and why I use it, and the reason why I also use moving averages, is because it gives us something into the future. Okay, so much of technical analysis is about what has happened. Or we have had a bullish engulfing candle. We have seen an evening star formation, all well and good, but again, it's not in the moment. Okay, the cloud shows us where support and resistance is in the future. Okay, and we can use these moving averages, which we're going to do later on, to show us support and resistance. Okay, where we're looking to buy. So you note here that for 14 days, okay, the dollar index has been confined to the Ishimoku cloud. When we get that on the daily and the weekly, we'll have a tendency to have choppy trading. Okay, and if you look here, you know, we've got down days, up days, spikes in both directions, support off the bottom of the cloud, rejection off the top of the cloud, okay, resistance, then back inside the cloud, more doji days, inside candles, which basically show that there's no immediate trend, and then this impulsive move back up. So basically what we've had, let's just get rid of these two lines for a sec, okay, is we've had the impulsive move up, and now we're in the corrective, or have been in the corrective leg lower. Okay, to get a proper breakout, okay, we also need to get outside of this channel. So we moved up overnight, we spiked through the top of the cloud again, and we moved back down. So there is scope for further selling, okay, but it should be limited to around about 80.26 in an ABCD formation. If we look to a fib, okay, so Fibonacci levels, we don't just use them for targets and extensions and to form Elliott wave analysis and symmetrical Gartleys and 1, 2, 3 patterns, etc., etc., etc. But we also use them for retracements, because we know that after an impulse move up, there will normally be a choppy retracement down. Okay, so we use the retracement tool to stick it on the low, move it up to the high. Okay, and this lines up with the 50%. So an ABCD formation, so you basically take the high down to the low, you then mirror that, okay, and move it across to your next swing high, which was there. And that makes it our support. So here, we've basically turned around and put, well, these are the prime reversal zones. First of all, it hit it, which was the bottom of the channel. Okay, so potentially a right shoulder in a bullish head and shoulders formation. It didn't break out. It held the top of the cloud. Okay, now we've come down, and now we've got this choppy trading. 80.88 we actually had as a resistance level yesterday in the dollar index, and it broke it to the upside, but it didn't clear the cloud, and it's come back and it's now retesting that level, as you can see, 80.70. A break below yesterday's low, and obviously that 80.32 comes into play, and then we'll expect dollar buying. So very hard to formulate, or very hard to pitch a long-term view in the dollar at the moment. It's mixed. Okay, me personally, I think we might have, if we can get above that daily cloud, then the dollar is gonna rally, as far as I'm concerned, in the next impulsive move to the upside. Okay, and then obviously would at least look for a flag formation. Okay, with a move up towards 82, 85. So one thing with trading, especially if you're trading sort of medium-term outlooks, is patience. I know we want to be involved every day in trades, etc., etc., etc. But patience is a very big part of trading. Okay, not to jump in because we think that we've got a signal to buy. One thing I will say is that there's two real reversal candles that I look for. If people haven't listened to one of my webinars before, I look for outside bars and I look for star formations. So an outside bar, let's have a look for it. Obviously, preferably at the high or low. Okay, it's not an engulfing candle. An outside bar fully takes over the previous candle. So you can see here we've got a bullish candle, but we do make a new high, but then we make a new low. Okay, so it completely takes out the previous candle. An engulfing candle just has to take out the body. That's not what we want to see. We want to see an outside candle formation. An evening star is here. Well, this is actually it's not an evening doji star, it's just an evening star formation. So a spike to the upside, green candle, preferably a red candle, but this one isn't, it's green, and then a red candle to the downside. Obviously, the stop above the high. So these work in all time frames. Just so happens that we're looking at a daily chart at the moment. Okay, obviously that reversed on the downside is known as a morning star formation. What we don't want to see, okay, which highlights indecision, is inside bars. So completely the opposite to an outside bar. So it's called an arami. It's inside the range of the previous bar. And there was one actually right at the top of dollar yen this morning. Okay, they show us indecision. Very hard to trade. You really have to wait for a breakout of the previous candle to at least give yourself a bit of a bias on where you can expect that currency pair to go. So getting back to the medium-term forecast, yes, the bias is to the upside, but at the moment there is scope for further selling. Okay, so that brings us on to our medium-term outlook for the different currency pairs. Now here we've got euro dollar. Again, I'm break it down all the way from a monthly chart down to a weekly chart, down to a daily chart. Okay, and then we're going to talk about later on potentially building a system about what we think is going to happen. Okay, and trading the shorter time frames. So here we've got a trend of lower highs. Okay, this could be seen as a monthly channel. Again, engulfing candle off the high here, or an outside, I shouldn't say engulfing. Outside bar, okay, morning star formation. So you can see here, just quite typically on this monthly chart, these reversal candles giving us the bias. Now, I don't know how big your pockets are. I don't trade off monthly charts, but I use it to give me a bias. So I know here, after July, the monthly July 2010 candle, I know the bias is to the upside. Okay, we get a false candle here. Okay, gives us an engulfing to the downside, gives us a little bit of follow through, but actually gets taken out of the high. An outside bar here, etc., etc. What we haven't seen at the moment on the monthly is any strong reversal. Okay, and you can actually see that from October we had a doji, okay, sell off, and then a complete rejection. Okay, so those two candles virtually cancelling each other out. So there is still scope to the upside in euro dollar, but the bias is to the downside because we hit the 61.8% pullback level. Okay, and we can see this move higher in three waves. So 1, 2, 3. It's not a perfect ABCD formation. Even if the dollar index was to push aggressively lower, we shouldn't see a break of this trend of lower weekly highs. Okay, so that's the monthly view. And the weekly, again, engulfing candles, okay. We want them at the bottom of trends. In the middle of a trend, it's continuation, okay. It's not as strong. This was not an engulfing candle to the downside, okay. But when we break it down into shorter time frames, we can obviously see the different bias, okay. So you're building up your bias on your time frames. So from here, obviously the bias is to the upside, but just because it's to the upside on the daily chart, does it mean that your bias is to the upside on the hourly, the 2 hourly, the 15 minutes, the 5 minutes, whatever your trigger, okay? And you've got to remember about your risk tolerance, okay? There's nothing wrong with taking a buy signal off a daily chart. But what you have to work out is your money management. If you turn around to yourself and turn around and say, right, I've got £10,000 in a trading account, I'm going to risk 2% per trade on my system, okay? So if you've got a daily trigger, so you've got £200 for your stop loss. If you've got a daily trigger and it's got a stop loss of 200 pips, it just means that your trade should be in £1 a point. If you take a trigger off a 15-minute chart and you've got a 20 pip stop loss, then obviously your trade should be in £10 a point. Okay, so you can work time frames to give you the same result, if you see what I'm saying, because candles work exactly the same no matter what time frame. It's your money management that matters if you're going to trade time frames, and I hope that makes sense. Okay, I know everybody goes on about pips. Excuse me a second. Somebody was saying, how many pips did that guy make last year or last month? You might say, well, that guy made 500 points last month. So great. So on his £10,000 account, how much did he make? And so, well, he actually only made £250. And you might get somebody else that only makes 100 points, but the monetary value of their account has gone up a lot more. Okay, you can't spend pips, you can spend money. Okay, it's about your percentage return and your percentage loss. So pips, yes, they are relevant, but they're relevant in different time frames. Okay, it's how much you risk against your reward, and obviously you've got to then focus on it's a minimum of 1 to 1, minimum of 2 to 1, minimum of 3 to 1, whatever your system tells you to do. Okay, but don't focus purely on pips. Focus on percentage return against your risk. So if you're risking £200, obviously you want a minimum of £200 back. Okay, and we're going to talk about bleeding trades and building up positions and all the rest of it. So the shorter the time frame, the smaller the pip risk, the larger your trade size should be. The larger the time frame, the larger the pip risk, the smaller your trade size should be. Okay, so you can take signals from different time frames. So breaking it down to, let's close the door. So breaking it down to shorter time frames, Euro-dollar daily. Okay, this is impulsive to the downside, and this is what we're looking for. We're looking for impulsive and corrective moves. Okay, we can sell impulsive moves to the majority of the candles close at the low. Corrections have spikes in them. Okay, obviously when we come towards the base of the trade, okay, we get indecision. So indecision, these are all inside candles. Okay, as we move, as we correct back to the upside. This was a false trigger. Okay, outside engulfing at 50%. What we have to remember about corrective patterns is it a small dog? It's a Cocker Spaniel. He thinks he's a lot bigger than he is. Corrective patterns are in 3 waves. Here we've only got 1 wave. Okay, so 1 wave corrective pattern. Okay, and then the 3rd wave up. So we've basically stalled. Okay, towards 61.8%. Again, there's no real reversal candles in these time frames. I mean, if we break it down, okay, the 4-hour chart doesn't give us any reversal candles. and nor does the hourly. Okay, so the bias is to the downside, but obviously the whole emphasis, especially on retail traders, because we don't want to have massive stock. Bank traders can have huge stocks. Bank traders can turn around and say, well, I'm sure Eurodollar is going to go down, so every time it keeps on going up, I'll keep selling into it and I'll keep on improving my average. Okay, we can't do that as retail traders, because the worst thing that we want to do is hold on or build into a losing trade. What we want to do is build into a winning trade. So I'm going to rattle. My bias is still to the downside in Eurodollar. If it breaks 85 today, then I think we could see maybe a stronger recovery towards this level. But remembering about that dollar index, okay, the dollar index has got a limited downside. So I know, or I think I know, that this correction higher is coming to an end, and now obviously the prime time is to try and pick that top, okay, which is obviously the hard part of trading. If it breaks above 85 intraday, which is this low, so we've broken the sequence of higher highs and higher lows, because we've now made lower highs and lower lows. If it moves above here, then that sequence is broken again. But like I said, I think from now on the bias is going to be to buy into dollar index moving lower, not to sell into dollar index going higher. Okay. So I'm just going to quickly go through the other major currency pairs. So here we've got a monthly trend. We have broken this trend to the upside, but we've got a 261.8% extension level in cable, which is holding at the moment. So our bias is to the downside, but we need to see strong reversals. And again, this is why we're going to look at shorter time frames. So we're going to talk about having a bias, and then we're going to talk about how to trade that bias. Dollar Swiss. Dollar Swiss is actually one of my favourite pairs because it does reflect the dollar index so well. Again, similar to the dollar index, we came down and hit that, the base of that potential head and shoulders formation, and then moved to the upside, but it's a false breakout. We can see a three wave pattern. A full, we've obviously hit 61.8%, but a full ABCD formation is literally just below, so we could see a bit of a double bottom formation come in and then a rally. But again, looking to buy into dollar losses, not the other way around at the moment. Dollar yen, this is quite an interesting one, obviously. This was the weekly triangle formation, and we broke out to the upside. We've had a sequence of higher highs and higher lows on the intraday chart. There was a small step lower, if you like, at 61.8%, and then we've overextended this to 61.8%. If you break this down into shorter time frames, I think most intraday time frames, not the 2 hour obviously, this isn't the same as charts that I normally use. I was going to say I've got on a 2 hour chart and a 4 hour chart, I think even a 6 hour chart, I've got an engulfing candle on the top side. I've actually made a note on my pad that 102.38 is an intraday exhaustion level. So for me, with dollar yen being up here, I'd like to see a bounce off 102.38 to get short, or I'd like a daily close underneath yesterday's low to give us an engulfing candle off the top, which is 102.21. So either way today, I'd either look intraday to sell into rallies or sell into corrections, probably around 102.91, 103.05 level, pretty relatively tight stop, about 30, 40 ticks, and then for a move back towards this previous high, which lines up with 61.8%. So I'm giving this pair a bearish bias at the moment. and also pretty close to a ABCD formation. Okay. Dollar CAD, again, thinking about the dollar bias, we consolidated in the channel formation. We've now broken out the channel formation. This is a weekly chart. There is scope for a retest of the breakout level. It does sometimes happen, sometimes it just fires and we don't see it. But thinking about the dollar bias, we've got that bullish dollar bias, and we're looking for that flag formation to play out. Buying on dips would be my best recommendation for dollar CAD, with a stop below or back inside the channel. So it's about 105 the figure, so you need stops around about sort of 104, 70, 80 level for a move, try and build long positions up towards 115.60. Aussie dollar, again thinking about the dollar bias. It's quite an interesting pair actually. I mean, that was actually bang on 50% of the last move lower, but this move up can be seen in 5 waves, so 1, 2, 3, 4, 5, okay, and this move lower in 3 waves, with inside 3 waves. So I think mild move up and then a move down to here, 89.57. Now I think that might then buck the dollar trend a bit, and I think we might see a bit of a move to the upside. If we don't, then the focus is at 50% level. And the focus is going to be back down on this, on the base of this weekly channel. Okay, so intraday and medium-term forecast is still to the downside, but obviously getting close to exhaustion levels. Euro sterling. This is a large monthly flag formation. Obviously, loads of scope for ample movement while we're inside. I think we'll be surprised this week if euro dollar doesn't start to move back to the upside. We've got a lot of price action around 82, 84, which is the weekly 50% Fibonacci level. It's also to the base of the weekly cloud, so we could see a spike and a move back inside. As I'm saying about breaking down through shorter time frames, at the moment there is no clear indication that there's a change of trend. Probably going to get an inside candle today, again highlighting indecision. So just to reiterate what we've talked about, dollar index, we've got a bullish bias with limited downside, looking to buy into dips. Euro dollar, limited upside. I think cable could have potentially made a top, but we haven't yet posted even a lower intraday low. So a bit risky trying to sell into gains at the moment in cable. Dollar Swiss, as long as the 61.8% pullback level holds, I'm bullish. Dollar yen, I'd like to see a decent reversal candle today. Dollar CAD would look to buy into dips with very decent risk reward. Try to build a long position up towards that flag formation target. Aussie dollar down towards 88.6 for the ABCD formation target, with possible move down to a channel base. And then euro sterling, mild bullish bias, but we need to see a bit of a stronger recovery from where we are at the moment. And if you think about that, obviously if we're using currency correlation, and I look at gold, well I do, but my colleague analyses gold, so I don't analyse his markets, not to the public anyway. So thinking about the bias with, I don't really want to get onto doing loads of different cross currencies and requests. I'll prefer to, only if you guys prefer to do it, but I'd prefer to talk about sort of trying to build a bit of a system. We've already done pound, dollar. they expect intervention from the Bank of Japan in some soon? No. Bank of Japan want weak yen, so I can't see them intervening. I think we could potentially, depending on where these currencies go, if we get strong moves in any directions, everyone's talking about cable being a safe haven. We don't really look at fundamentals, okay? Sorry guys, but does everybody want me to do requests, or should we talk about a short-term trading system? I'm quite happy to do both. I don't look at. I'll only analyse markets that I cover. New Zealand dollar isn't one of them. Let's do both. I'm not a miracle worker. It's I've got 20 minutes left. Okay. I'm just going to show you something quickly. As some of you might like it, some of you might not. Okay. Do I think I know where the market goes? Yes, the majority of the time we get our calls correct, but there are obviously times when we don't get our calls correct, and that's just a part of trading. If you've got a short-term trigger system, if you like, that keeps you in the trend, okay, this is a trend following system, a very basic trend following system. Then to a certain extent, and I'm going to say this with a pinch of salt, to a certain extent you do not need to know where the market is going because you're going to trade the system. So obviously my argument is going to be, is it better to trade a system or is it better to trade a view? I think that it's better to trade both, okay, to have a short-term trigger system which you can then use or overlay on your view. Okay, so what I'm going to do here is add some studies, and I'm not going to add loads of studies. I'm just going to add, I think, about 4 studies. So what I want to do is, how do we know if we're in an uptrend? Okay, well, we get higher highs and higher lows. Well, what defines a trend? I was actually having a drink last night in London with a pal of mine, and I said, how do you define a trend? He came out with exactly the answer I wanted him to. And he said, in what time frame? And that's my point. That's what I always look to, time frame. Just because euro dollar might be bullish in a daily chart, it might be very bearish on a 3-minute, 5-minute, 15-minute chart. Okay, so you've got to decide, first of all, what time frame you're going to look at triggering. And this brings us back to the money management before. Okay, you can have a turn of pip stop if your trade size is 10th lower than when you have a 20 pip stop. So there's nothing wrong with trading shorter time frames or longer time frames, and that's what I'm trying to get across. So what we're going to do is going to build a very basic system very quickly. So basically, to define a trend, I also like to use moving averages, okay? But I like to use them as support resistance, and I also like to use them to define that especially short term, to define that short term trend is bullish or bearish, okay? So as well as looking to crossovers. So we're going to put 2 moving averages on, okay? So we've got a 50 and a 10. And you can't have your moving averages too close together because otherwise they'll just be crossing all the time and you won't be able to define a trend. Do you remember, moving averages are really there for a visual effect. So you can look at it very quickly and say, well, yes, it has corrected lower, but what is the trend? Is the trend still to the upside? Okay. And then what we'll put on, and this is really for the short time frames, but I'm just going to mirror these charts. I can see it, parabolic. Where are you? Has it got parabolic trends? Parabolic SAR. Okay. And parabolic SAR really helps us out again in the short time frames, okay, to define stops patterns that postman, pre-deliveries, different things. I do apologise. And then, this is just for the larger time frame, okay, the Ishimoku cloud. And then we're basically going to go weekly. And we're going to mirror all of these. We're just going to clone these charts. Take 2 seconds. I won't go too far down in time frames. Well, I agree, there's a massive bear coming in your record. Right at this second. I don't know, we'll wait and see. I don't think so. I've got Eurodollar chart on, and I haven't got any reversal signals, that's for sure. Okay, so then we're just going to break down the time frames. So, daily. Okay, 4 hours. 1 hour. 15 minutes. And I'll go down to 3 and 1 minute for scalping, but I'm just going to put 5 on now. Okay. And all I want to show you is this. We'll get rid of Ichimoku in these shorter time frames. So basically off the daily chart, off the weekly chart, we want to note points of support and resistance, okay? So you basically want to be a Marubozu level. The Marubozu level is the midpoint of a strong bullish or bearish candle formation. So I'm not going to do an exact level at the moment, but the Marubozu level, you'll have to work it out. Take the high and the low, sorry, the open and the close and divide by 2. So the Marubozu level is about there. It's not just the Marubozu level, it's previous resistance from here and from here, okay? So we know there's going to be resistance to the upside. Now, on the weekly chart, what is the bias? Well, the bias is really to the downside because we're below the Marubozu, okay? If you're looking at weekly charts, you really need to break at this level to confirm that the bias is still to the downside, or to confirm that the second leg of wave of selling is to the downside. Okay, but as long as we stay above the Marubozu level and above these spikes, then it's more bearish than bullish. Sorry, so I should mention, as we look at this chart, where are the moving averages? So we'll get rid of the cloud because it's too far away. Okay, so the moving averages are pointing higher. Okay, they're trending higher. So if you were to take signals from your weekly chart, you'd only take daily signals. Okay, but you would then look to the daily chart for morning star formations, which show a low trade is in place, or an engulfing pattern. Okay, and this is how you do it from breaking down from different time frames. So remember, we can only take bullish signals. Okay, so we have no bullish signals all the way down because the weekly chart is telling the daily chart that you should be buying because the trend is still to the upside. Okay, so we get no bullish signals. Okay, here we've obviously got that Marabuzo, so we've held that. We then put on fib levels, retracement levels. And we want to be looking at those in shorter time frames. Okay, so we're breaking down time frames. Now, in this time frame, we know there's cloud cover. Okay, so again, we're just going to get rid of the cloud. So we know there's resistance to the upside. We know we've got 61.8% fib here at 136.26. We know off the weekly chart, there's a Marabuzo level approximately 136.33. Okay, so we know we've got cloud cover. If we look to an ABCD formation, remember we're not trading this time frame at the moment because we haven't got any signals. So if we look for an ABCD formation, we've got 136.81. So we've got a massive area between 136.26 and 136.81 where we can be looking for for signals in shorter time frames. Okay, not in this kind of formation or in this time frame formation. So if you delete the Ishimoku cloud, what do the moving averages tell us now? Well, the moving averages tell us now that in shorter time frames, and we're breaking it down, okay, we've crossed over. This was the bull trend. So while we're in this bull trend, we should have been taking 4-hour and hourly buy signals. This has crossed over. We're now in a bear trend. Okay, so if we break it down into 4-hour charts, we should be looking for outside bars, okay, or morning star formations. But we haven't got any. Okay, so we're invalidating these counts. We've still got that bearish bias, but until we get a signal, we can't pull the trigger. Okay. Now on the 4-hour chart, but don't lose anybody here. On a 4-hour chart, what is the bias? The bias is to the upside because the moving averages are now pointing higher. Okay. So on a 1-hour chart, we should be looking for engulfing patterns to the upside. Okay. And you can basically break it all the way down. So if you get your signal, and your signal is on an hourly chart, and you're risking 2%, and your hourly chart is a stop at 30 pips, and you want to risk £200 on that trade, then you work out how much you should be trading per point. Okay. But where you really want to be getting your signals, because none of us are particularly happy about having huge stops, is in the shorter time frames. Okay. So here on the hourly, the trend is still to the downside. Okay, so on the 15-minute, 5-minute charts, we should be looking for reversal candles. Okay, but we haven't got any. Again, there's no reversal candles. So literally from this point, when this crossed over, in your shorter time frame, in your 3 minutes, maybe in a minute if you're scalping, then in the shorter time frames, you should be buying this on bullish signals. So basically on the 5-minute time frame, you want to be looking for outside bars after that crossover. So there's an bullish outside bar here. And sorry, there's a caveat to this. You want to be buying it at your trend line, at your moving average. Because what we don't want to be doing is we don't want to be buying the highs. Okay, we don't want to be buying the highs, we don't want to be selling the lows. We'd love to be able to sell the high and to buy the low, but this is a trend following, very basic trend following system. Okay, so basically you're looking for dips. You'll always hear traders saying, I'm bullish, I'm looking for dips to buy into. Okay, and that's exactly what this is doing, but you don't want the dips to break through your support, and your support in your system is your moving average. Okay, so basically you buy the outside bars because they're showing you that the bias, that short-term bias was to the downside, is now not, it's to the upside. Okay, use the parabolic SAR as your stop for that candle. Okay, when you've got risk off, and risk is the candle. Okay, so Say you bought that at the close, 135.44. You've got a tight stop, 135.40. So you want to be getting your first unit off. Because you've got to trade in 2 units, otherwise you can't manage the system. Okay, so you get your first unit off at 135.49. When you get your first unit off at 135.49, that stop then becomes to entry, okay, for your balance. And that's how you can build and bleed a trade higher, okay, by trading in smaller amounts, getting some money back for your risk, okay. So what if your risk is 5 ticks? Take your first half off at 5 ticks, then move your stop to entry, okay. Then you've got the free trade, what they call the bleeder, okay, and then you just keep on moving it. I don't actually have a trading stop. I'll wait until I get a decent reversal signal to the downside. Okay. Here again, we've dipped. We get an outside bar. Okay. The stop has to be here. When the parabolic ZAR has moved up to the base of your trigger candle, then you can put your stop to the bottom of the trigger candle. Your stop is larger here. Okay. So we triggered 135.53. Parabolic ZAR's coming in at 135.45, so 8 ticks. So your target is 65 for your first unit, which is up here. Okay, so that will be your first unit off, and then you stop to entry. So by this point, or by the time it gets here, you've taken 2 small profits. Okay, your average trade for your 2 units that you've got left on is around about here, okay, from the midpoint of this candle and this candle, okay, and the market is up here, okay, so you've bled the move higher. What you obviously have to be careful of is the change of the quick change of trend, okay, if you're trying to do it through news releases, if Bernanke or Yellen or anybody else comes out and says something while you're doing it. So you've got to have that stop in place. But you're basically using the time frame before to define your short-term trend. So the weekly trend can be up. You can take daily triggers. The daily trigger can be up. You can take 4-hour triggers. The 4-hour trigger can be up. You can take hourly triggers to the upside. But the hourly is to the downside, okay? This is still highlighting a downside. So as soon as I would get a reversal candle in 15 minutes, then all those buy trades that you've built in your 5-minute trend would be cancelled, okay? You'd close those. So what you're really waiting for here is a reversal candle in the 15 minutes to get you short to trade the hourly. Does that make sense? So it's all about trade size, money management, and knowing what trend you're in what time frame you're in. You can add a few other sort of basic studies to it, but I really wouldn't. You don't want to get too carried away. Slow stochastics is great for a system like this because I use them all, Michael. I try to build positions off all time frames. I have a chart in front of me that basically turns around and gives me the ATR, which is the average true range of all the currency pairs that I cover. It tells me what trade size I should take for a daily trigger, a 4-hour trigger, 2-hour, 1 hour, 15 minutes, 10, 5, 3 and 1. And my risk is virtually monetary wise, my risk is virtually the same for every trigger I take. So the slow stochastic is good for confirming that turnaround. Okay, so basically here, if we get an outside bar here, slow stochastic or overbought, it's going to tip through, and I'd expect a decent move to the downside. 15 minutes. Don't use slow stochastics on its own. Don't use any indicator on its own. because indicators are lagging indicators. The majority of them are, apart from Ishimoku Cloud, etc., etc., etc. Right. Yeah, so use the time frames. And what you have to do, if you're working to a system like this, and obviously trial it first, use different moving averages, maybe use the RSI instead of the slow stochastic, blah, 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 blah. Trial it first, but then when you have trialed it, and if it's showing you more wins than losses, then every time you get a signal, you have to press the button. And that's the difference between trading a system that you develop or trading a view that you have on the market. Okay, two completely, not always completely different things. Hopefully, sometimes they're the same. But okay, if you have a system, then you have to stick to that system. And if that system says to you, right, you've got to buy it here, or you've got to sell it there, then you've got to do it, even if you've got a feeling it's going to be a loser, because invariably the ones that you think are going to be wrong have a tendency to be the ones that are right. Any questions? So look at different time frames. Don't get stuck into, don't turn around and say, well, I'll trade off euro dollar and I look to sort of a 1 minute time frame. No, always look to what the big picture is telling you. Obviously, if you've got bigger screens, if you can get your charts lined up next to each other, okay, so you've got sort of your hourly here, 15, 5, and maybe 3. A lot of future traders use 3-minute charts. And then obviously you can see what the trend is and what is happening in those different time frames at the same time. So you're not having to flick through your different time frames. Any questions at all? Best to eyeball it. Yeah, it's a visual thing. I mean, I think for a novice or for people that are quite new to trading, I think trading, everyone says you've got to trade with the trend. Or ask a 6-year-old. Ask a 6-year-old what a trend is. Yeah, I mean, but isn't that the whole problem with the majority of traders? It's that we all try to pick the top and pick the bottoms. And invariably what you should be doing is just buying the currency pair as it's going up. You know, if you traded this system in dollar yen when it's had a strong upward trend for the last 3-4 weeks, and you built a position from shorter time frames, you know, it's obviously when the market isn't trending. But when the market isn't trending, what are these oscillators doing? Or what are these moving averages doing? If these oscillators if the market isn't trending, they're flat. Okay, your stochastics will be around the middle. Okay, and these will be crossing over continuously, highlighting that there's no trend in that time frame. I'm not telling you to do it. I'm just telling you it's a way you can do it. And isn't that the whole point of doing educational webinars? Any other questions? Through First for Trading, we take, on 22 products, we probably get 18 trades a day. And personally, my trades are probably about the same, about 18 trades a day, but I don't necessarily take all the ones, or I don't necessarily trade every currency pair. What I have a tendency to do myself is if I get into a currency pair in the morning, so I've bought into dollar Swiss and it's going in my direction, then I'll have a tendency to concentrate on that one for the day and maybe 2 others. But I will build trades within that currency pair, if you see what I'm saying. And I do have my favourites, dollar Swiss being one of them. Okay, guys, if there's no other questions, I should bid you farewell. Thanks for listening. I hope it's been helpful. And I'll see you all again in the new year. Okay, have a great Christmas and a New Year break. Okay, thanks very much. Bye for now.